Welcome to The Exit Strategist and our presentation, How You Sell Your Business Will Determine Its Selling Price. How much is my business worth? That depends. Of course it depends on profits, sales, EBITDA, and other traditional valuation metrics. A surprisingly important factor, however, is how you choose to sell it. We have actually seen examples in our merger and acquisition practice where business owners have received less than 50% of the value they would have received had they elected to sell using a professionally managed, competitive bidding process. We will use a series of graphs to illustrate this concept. The way to achieve the most value from the sale of your company is to get several strategic buyers all competing in a soft auction process. That is the holy grail of company valuation. There are several exit or value option strategies. Let's examine each one, starting with the lowest, which is liquidation value. Liquidation value is basically the sale of the hard assets of the business as it ceases to be a going concern. No value is given for goodwill, brand name, customer lists, or company earnings potential. Unfortunately, this is the way many businesses are sold if the owner has a debilitating health issue or unexpectedly dies. This is a sad way to exit a business that you have spent 20 years of your life building. Book value is simply an accounting treatment of the physical assets. Book value is generally not even close to the true value of a business. It only accounts for the current assets and for the depreciated value of physical assets and does not take into account such things as earnings power, proprietary technology, competitive advantage, growth rate, and many other important factors in value. In case you are working on a shareholder agreement and looking for a methodology for calculating a buyout, book value is a terrible metric to use. A better approach would be a multiple of sales or an EBITDA multiple. An unsolicited offer to buy from a competitor. This is the next step up in value. Unfortunately, many business owners end up exiting their business with this valuation technique and leave tremendous amounts of value on the table. The best way I can describe the buyer mindset is that they are hoping to get lucky and buy your company at a bargain price. If you, the unsuspecting seller, bites or makes a weak counteroffer, the competitor gets a great deal. If the seller is diligent and understands the real value of his company, he sends this bottom feeder packing. Another tactic from this bargain seeker is to propose a reasonable offer in a qualified letter of intent and then embark on an exhaustive due diligence process. He and his advisors will uncover every little flaw in the target company and begin the process of chipping away at value and lowering the original purchase offer. He is counting on the seller simply wearing down since he has invested so much in the process, and he's hoping he accepts the significantly lower offer. Buyer introduced by the seller's professional advisors. Unfortunately, this is another commonly executed yet flawed approach to maximizing the seller's transaction value. The seller confides in his banker, financial advisor, accountant, or attorney that he is considering selling. The well-meaning advisor will often know somebody in the same business and will provide an introduction. This introduction often results in a bidding process of only one buyer. That buyer has no motivation to offer anything but a discounted price. Rule of thumb valuations from a professional business valuation firm. These valuations are generally at the midpoint in the value chain. They are usually done in response to a need, such as gift or estate taxes, setting up an ESOP, a divorce, insurance, or estate planning. These valuations are conservative by nature and are generally done strictly by the numbers. The valuation firms use several techniques, including industry comps, rules of thumb, and discounted cash flow. These methods are not great in accounting for strategic value factors such as key customers, intellectual capital, or a competitive bidding process from several buyers. Private equity or financial buyers. In this environment, except for the mega deals, there is still a great deal of money sitting on the sidelines waiting to be invested by the private equity groups. They still have their roots as financial buyers and go strictly by the numbers, but they have brought the multiples that they are willing to pay back down to historical normal levels. Where 2 years ago they would buy a bricks and mortar company for 7 times EBITDA, they are now paying a more traditional 5.5 times EBITDA. Strategic buyer. A good investment banker will attempt to establish a strategic fit between seller and buyer. The advisor will position the selling company in order to paint a picture of 1 + 1 = 3.5. Factors such as eliminating duplication of function, cross-selling each other's products into the other's install base, using the seller's product to enhance the competitive position of the buying company's key products, and extending the life of buyer's technology are examples of this artful positioning that help drive transaction value. Strategic buyers in a bidding process. The holy grail of transaction value for business sellers is to have several buyers that are actively seeking to acquire the target company. One of the luckiest things that has happened in our clients' favor as they were engaged in selling their company was an announcement that a big company just acquired one of our client's competitors. All of a sudden, our client becomes a strategic prize target for the competitors of the buying company. If for no other reason than to protect market share, these buyers come out of the woodwork with some very aggressive offers. Even if there is currently no buying activity in the seller's industry niche, a good merger and acquisition firm attempts to stimulate the same kind of competitive market dynamic. By positioning the seller as a potential strategic target for several competitors, the industry players often step up with aggressive valuations in a defensive posture. Of course, the merger and acquisition teams of the buyers are conditioned to deflect these approaches. However, they realize that their competitors are getting the same presentation. They have to ask themselves, which of these strategic platforms will resonate with their competitors' decision makers? As you can see, the value of your business can be subjectively interpreted depending on the lenses through which it is viewed. The decision you make on how your business is sold will determine how value is interpreted and can result in 40%, 60%, or even 100% increases in your sales proceeds. Are you thinking of selling your business? Most business owners only sell one business in their lifetime. The results of that sale can have a major impact on the financial future of the family. Subscribe to our Exit Strategist newsletter, which contains a wealth of useful advice to help guide you through your business sale process. We are constantly updating our knowledge base with actual experiences from many successful business sale engagements. Subscribe today at www.midmarkcap.com/exit and learn about new tools to reduce taxes, creative deal structures, valuations, buyer negotiation tactics, how to maximize your selling price, and much more. Hope to see you in the future. Thanks.